In today's business world, companies often have to manage many different products or units, and it can be difficult to know where to put resources for the best results. The GE McKinsey Matrix is a tool created by General Electric and McKinsey & Company to help with this decision. It looks at two key factors: how attractive the industry is and how strong the business unit is within that industry. Unlike simpler methods, this matrix uses a 9-box grid to give a clearer picture of where to invest, grow, or pull back. For example, if a business unit is in a highly attractive industry and has strong market strength, it's a prime candidate for investment and growth. On the other hand, units in less attractive industries or weaker positions might be targeted for selective investment or divestment. This approach helps companies manage their portfolios in a more strategic and detailed way. The GE McKinsey Matrix is a useful tool that helps businesses allocate resources effectively by identifying which units deserve more investment and which might need to be divested. It brings strategic clarity by offering a structured way to evaluate complex portfolios, supporting long-term decisions about whether to grow, maintain, or exit different business areas. It also helps with risk management by highlighting units with low attractiveness or weak competitive positions early on. The matrix is structured as a 3x3 grid with industry attractiveness on the vertical axis and business unit strength on the horizontal axis, both rated as high, medium, or low. To build it, you start by listing all business units, then assess industry attractiveness based on factors like market size and growth potential, scoring each unit. Next, evaluate business unit strength using criteria such as market share and innovation capability. Plot these scores on the matrix, which guides you to invest or grow units in highly attractive industries with strong strength, selectively invest in average areas, and consider harvesting or divesting units in less attractive or weak positions. Real-world companies like General Electric have used this matrix to manage diverse portfolios, choosing which sectors to expand or exit. Similarly, Unilever uses it to decide which brands to grow or phase out, and tech companies like Google apply this approach to balance investment between high-growth innovations and established segments. Overall, the matrix plays a crucial role in maximizing shareholder value and maintaining competitive advantage for large, diversified corporations. This matrix offers a comprehensive analysis by taking into account multiple factors beyond just market share and growth, making it especially useful for large, diversified companies. It encourages businesses to think strategically with a long-term perspective rather than focusing on short-term gains. However, it's important to recognize that the approach can be complex, requiring extensive data collection and subjective judgments. It also demands significant time and resources to gather and analyze the necessary information. Additionally, because market conditions can change rapidly, the matrix can become outdated if it's not regularly updated. Despite these challenges, the GE McKinsey Matrix remains a valuable tool for managing a portfolio of business units. By evaluating both industry attractiveness and the strength of business units, companies are better equipped to make informed decisions about where to invest, maintain, or divest. The effort put into this process can lead to much better resource allocation and improved long-term profitability. For companies handling multiple units, it's more than just a theory, it's a practical guide that supports sustainable growth over time.